welcome to another important episode of Finance Footnotes. I'm your host, Brent Stransky, joined by my friend and colleague and co-host, Zach Miner. And today is an important episode. There's a lot going on in the markets. We're approaching September and the end of the year. Everyone's back from vacation, and it's the time to dig in a little deeper than usual and look at the comings and goings here in the marketplace. So that's what we're going to start with today, per usual. Let's take a look at the stock market indexes and see where they ended August. And so today I have a chart here from the Wall Street Journal looking at two of the three primary indicators of indexes, the Dow Jones and the S&P. And darn Zach, they didn't finish a volatile month at or near all-time highs. Surprisingly, if you remember, everyone, first 3 days of the first three trading days of August were down like 8-ish%, 10% on some indexes. And gosh, the market slowly, methodically clawed its way all the way back, which was happy to see. And I'm showing that here on the next chart. Where are we? This is also from the Wall Street Journal, and they're indicating here on the front page that of the journal this morning that markets, everyone's back from vacation. And you can see here that while the NASDAQ was down at one point over 10% in early August, you can see it did climb back. And in the first that July and August, the Dow up 6% and the S&P 500 up 3.2%. So not a bad summer. Zach, what do you think?
Yeah, well, September is living up to its reputation as being a seasonally weak period today. Market's down, S&P's down like almost 2.5% today. And then I'm not much of a chartist. I tend to look more at fundamentals than at technical analysis when you're kind of looking at charts. But there are some patterns that I think are worthwhile looking at, and one of them is a double top. So if you do look at the S&P 500, you do see those peaks right there, right prior to the August decline. And then our September or our August rebound didn't get back to all-time highs. It got close, but it didn't quite get there. And so if we were to kind of roll over here, that is a fairly strong, typically a strong signal of...
And what signal of what? Yeah.
Of some weakness to come, because that essentially means that barrier that, right at that all-time high number, just couldn't be breached. There weren't any more kind of buying pressure to get us above that. So, something to keep in mind, and especially going into September, which is typically a seasonally weak period.
Exactly. And so to build on that, here we are at or near all-time highs. Market powered through a pretty strong summer. We've looked at the CNN Fear Greed Index before, and I think it's a great indicator. It compiles 5 or 6 very important data points, one of them being my all-time favorite, the put-call ratio, and aggregates them in just an easy-to-read speedometer score-like methodology here. And you can see it's at 70. If you remember, it was just a month ago, we were all the way down near extreme fear. So folks in the marketplace are relatively optimistic here going forward. Zach, to your point earlier, led right into one of my slides here. September tends to be the worst month of the year historically, but I think the last 4 Septembers, correct me if I'm wrong, Zach, were particularly ugly. There'll always be a chance for September, this one or next.
I think 7 of the last 8, I think, were negative, and the one positive was like a 0.3. Like it was marginally positive. So, I think folks tend to come back from summer vacations with trades on their mind, rebalancing, and you kind of get back to it, and it just tends to lead to some volatility.
It's also one of those things it's kind of a known quantity here in the markets. September tends to be the worst market, and it's sooner or later, just like the some other indicators we've spoke about in weeks prior here on Finance Footnotes. Indicators such as inversion in the yield curve may indicate a recession. It's never been wrong until this time, when it's been wrong for a period of time. Not that it's always wrong. We'll have to wait and see. There will be a September that's positive, is all I'm saying. The chart I have here is really interesting. It's from our friend Ryan Dietrich at Carson Wealth, and he's just showing over the last 73 years what it looks like in September. And actually things look pretty okay until like the 19th, which he called Speak Like a Pirate Day, National Speak Like a Pirate Day. Never heard that, Zach. You've got kids. Have you heard of that?
I have not. I'm not sure entirely why.
Yeah, I don't know why either. And I tried to think about it for a moment. I couldn't come with a good excuse. So I wanted to just point out that we're near all-time highs. Optimism is very high. We're coming into a seasonally weak month, which doesn't mean you should make any changes, folks. It's impossible to call the top and the bottom, especially in a short time frame. But I did want to highlight an important chart. Zach, you've highlighted this chart before. It's from our friends at JP Morgan Bank. I use the term friends loosely. We don't know these people, but they're really smart. In fact, they update their charts daily now, and you can go and get this information for free. But this is one of the slides. They're updated through Friday's close, and you can see here that the price to earnings ratio, it's 1.2 standard deviations above normal at 21 times earnings. Okay. I'm just showing you this chart. It looks very impressive. The point I want to make here, Zach, it's one we made before, is that things are frothy. Things are toppish. We're not, it's not a value-based market. There's a lot of froth here. We're at, points where it would make sense to be more prudent or judicious as you're allocating new capital. What do you think of when you see this chart?
Yeah, certainly. And we've looked at the kind of timing indicators of it, where a 1 year forward basis, that really doesn't tell you anything about, future returns. But on a 3 or 5 year forward basis, your starting valuation does matter. And so there's a couple, things, a confluence of factors, a fairly highly valued market, seasonally weak September, going into an uncertain election with, tax policy and economic policy, not really sure what that's going to look like. So I think all those factors, I even just saw on CNBC that Tom Lee, who is typically and he's been correctly bullish. He's been very correct in that prognostication. But even he's saying, we're potentially primed for a correction just because we've had such a strong year thus far.
It's a pretty easy call to make in September when it's been down 7 of the previous 8. So
right.
That's exactly right, Zach. Thanks for making that point. Things, this indicator, price to earnings, is not a particularly excellent indicator in the short term, but in the 3, 5, and 10 year space, hey, it's proven it's worth something to be aware of. And listen, it leads right into my next slide. This is front page of the Wall Street Journal this morning, first trading day of September. And I have a little clipping here. You can see this is front page, investor attitudes on stocks gets ultra bullish. Really intriguing here. So if you look here towards this is just a quote from that article. U.S. households have 42% of their overall total wealth invested in stocks, the highest since records began in 1952. This really blew me away. If you look at this chart, especially going back, even to 10 years, 20 years ago, it's been a precipitous incline in the percentage of assets and wealth we have invested in the stock market. I think this kind of leads to the point that I'm making, that things seem ultra. People seem very bullish at the moment, I would say, at least in the news. But I wanted to highlight this and to kind of pivot, Zach. I'd like your feedback. It's colloquial as it is. I couldn't find any data to support this as I looked on the Google. But it seemed to me that a lot of the articles I'm reading, evidenced here by this article from the Wall Street Journal, it seems to me there's been a lot of front page articles about, to your point about Tom Lee, like people calling tops. And I just, in my experience, which is only 19 years of experience, folks, I don't remember that being the case. If the market's topping, if you're seeing a lot of smart people calling for the top,
Right.
So that's kind of counter indication to me. What are your thoughts and feelings on that?
I mean, it's a similar thing coming out of 2022, and we had that significant decline. A lot of folks were calling, everyone was calling for the recession, right? Never really happened. And what a little commentary on this one chart here, this 42% of the wealth chart. And I've talked about this before, about my hesitance to read too much into super long-term charts like this. I mean, this is going back to the 1950s, where the very nature of the economy, the market, I mean, everything is different than it was in 1950, right? So I'm hesitant to take too much out of this. You can think for several reasons why. Just the rise of 401k availability, the rise of passive index investments that now make up a much larger percentage of folks' retirement accounts. Just the fact that public equity prices have kind of outpaced, housing prices, and that typically had been a large store of wealth, and it still is a large store of wealth, but just proportionality. So I don't necessarily look at, and I look at the one thing on the left-hand side there where U.S. investors have rarely been this giddy about the stock market. I mean, I don't think this says that at all. I think this is just a kind of inertia.
That's to my point about the media sources kind of promoting these markets are at tops. And I just feel like when that happens, it's not necessarily an indication that we're actually at a top. Time will tell. Time will
Yeah.
absolutely tell. The point I wanted to make here, and I've got two more points I want to make. I'll hand it over to you. I'm going to talk a little bit about politics. I'm sorry, everyone at home, and then I'm going to end with one positive note here because I don't want to be so pessimistic. But what do you do with new money? Been meeting with a lot of new folks who are wondering what to do with new money, either cash on the sidelines or a portfolio that's at near time highs or all time highs. And I think the answer at this moment, Zach, please jump in here. I think it's a prudent time to diversify. If you're doing just a traditional 60-40 split, it's a good time to diversify and rebalance. Okay. And then secondly, I think it's a good time to look towards options to diversify in alternatives, such as, alternative investments. To leave it at that for compliance reasons, but you can contact your friendly financial advisor for more information. But that being the case, I think it's a prudent time to maybe diversify and spread some assets across the table here with stocks at all-time highs. What do you think?
Yeah, and just the declining percentage of overall GDP and overall company market capitalization being represented in public markets has just continued to shrink. There's a lot more private companies. There's a lot more very strong private companies. There's a lot more companies that are choosing not to go public for a variety of reasons. There's a lot of companies being taken private from public markets. And so the public markets are representing a smaller and smaller share of overall US GDP. So if you want, exposure to a broader swath of the market, then that's, the way that you're going to have to get access to it.
I think that's very true. That being said, final thought on this, investing is for the long term. Take a note out of Warren Buffett's playbook. It's not about months and days and quarters. It's about years and decades. Okay. And that being said, I do believe there's plenty of opportunity in that time frame if you keep that in mind. So turning the page here, let's talk a little bit about the politics. These are a couple of interesting polls that came out of the Wall Street Journal, which is one of the major polling sources, right? Sorry that I'm quoting two Wall Street Journal articles here, but I do often follow other news sources. We'll quote them going forward as they release data, but this is just from this morning from the Wall Street Journal. And I'm going to tiptoe into the political discussion here because the economy, people vote with their pocketbooks, as everyone knows. So here's just a poll that was from the last week in July, so just a couple days old, and asked 1,500 participants, is the economy improving? 34% of the people said yes. That's up from 26%. And while it still seems very low, and it is, it's a dramatic improvement from that period just 7 weeks prior. And then kind of on that, is the economy worsening? Okay, this plays very importantly into Vice President Harris's presidential campaign. And then 48%, yes, the economy is worsening, but that's an improvement from 54% just 7 weeks prior. Okay. Is the country heading in the right direction? Another important question you often hear. 30% say yes, up 21%. So I think in general, the 2 points I pulled away from this is that number one, things are generally improving, but from a weak place. Okay, so we'll have to see how things pan out here. There's a debate coming forward. I think this weekend. Yeah,
maybe next week, maybe next Tuesday or something like that.
10th or something.
Yeah.
It's going to be interesting, folks. It's going to be very interesting as this whole entire election process has been. I also wanted to highlight, this is data that came out, I believe, on end of last week. This is from University of Michigan Consumer Sentiment Survey. It's a very prominent source for, hey, how the heck are people feeling in your neighborhood? And this is a 10-year chart, and you can see that it has been, this is the dotted line is the 1 month, and then the blue bold line is the 3 months 3-month moving average. And you can see that it has improved since 2 years ago, mid 2022, but off recent highs. So I guess when I look at this too, Zach, I'm kind of surprised. Like even looking back pre-COVID, like we're nowhere near the confidence or happiness in the economy that we were before then. And I guess a lot of that has to do with inflation.
Yeah, I definitely agree. And it's interesting that it hadn't kind of rebounded at least to 2021 levels, prior to 2022. So it definitely is. It is interesting, but it is trending positively.
And the only reason I bring this up, because I do think it's an important variable here in how people vote, and we'll have to wait just a couple months, 2 months. Oh my God, 2 months away, folks. Here we go.
61 days. Yeah.
That being said, I wanted to share with you some recent data from a Wall Street Journal poll. And this is interesting. This is front page on Friday, and it showed that for the first time, Harris took a lead over Trump by 1%. It was 48 to 47. Meaningful, couple things, well within the 2.5% margin of error, which, as we know from statistics in the last couple of presidential elections, it ought to be more like a 10% margin of error. But interesting nonetheless. And you can see here that Trump was enjoying a large kind of win ratio, or polling over Harris, but that's certainly eroded here. And what we can see is that there's been a bump here from the DNC convention. A couple of points I want to highlight. And number one, that's super small. I have to increase that here a little bit, folks. Sorry. But as I'm looking at this, do you perceive Trump as favorable or unfavorable? Maybe not surprising. 45% say favorable, 53% say unfavorable. Harris, 49% positive and negative. So really interesting. And then finally, the final point I wanted to make here. Do you approve or disapprove of the job Harris is doing as vice president? Only 42% approve and 51% disapprove. I think these are interesting factors. Maybe some of them will be, poked at during the debate. We'll have to wait and see. Yeah, I think we'll have to. Well, I think the next big pivot point here is going to be the debate, and then everything's up for grabs after that.
Yeah, I mean the major takeaway I think is as of right now, it's just squarely in the margin of error, right? I mean it's a total coin flip. I think as of today, where we look at it, next week could change things depending on how the debate goes. There is a sentencing hearing, I believe, at the end of September for Trump's New York case. I don't, who knows what that's gonna end up changing. But I my guess, if I had to guess, that we're going to go into this election within the margin of error, and it's going to come down to 15, 20, 25,000 folks in
Pennsylvania and
5 states,
Georgia.
Yeah. Right. So I mean, it's going to be razor
for you
thin.
folks in Pennsylvania. I saw an interesting article. I was talking about TV ad spend by the Trump and Harris campaigns. And Pennsylvania has twice the spend of the next nearest state, which is Ohio. So Pennsylvania is seeing a much larger spend on ads on television for political campaigns than anyone else. So
as someone in Pennsylvania, I can confirm that is accurate, that every other ad on my screen and computer, and I literally can't turn away without seeing a political ad. So I can confirm that is accurate here in the state of Pennsylvania.
You're not the only one, my friend. So I'm going to end on some interesting, maybe some positive outlook here, and then I'll turn it over to you. I just saw this from our friend Ryan Dietrich 2 Fridays ago, and it's right after a very broad move upwards in the equity markets that day. And what he's looking at here is historical volume when you have number of advancers versus number of decliners. And he's pointing out here, this is not a bearish signal. This is a positive signal. So on that day, there were 11 advancing stocks for every declining. That's a very high margin, Zach, as you know. Yeah. And I thought this is really interesting. So 12 months forward, and this is data going back, 45 years. And what it's showing you is there have been 47 times that happened. This is the 48th. And going forward 12 months later, it's not always too attractive in the 1, 3, and 6 month periods. But going forward a full 12 months, positive 85% of the time. I think that's, I think that's all we can hope for. I think it's a pretty good data set. And I think there's evidence, there's momentum in this marketplace, and it could continue throughout the election.
Yeah, absolutely. My first one is, I want to just highlight something, fairly interesting that I saw and could be concerning. What we're looking at is the percent of balances that are seriously delinquent by type of debt. So you have mortgage debt, revolving debt, auto loans, credit cards, and student loans. And 90 plus days delinquent is seriously delinquent. And the two lines that I want to highlight are the credit card and student loans. So you have credit cards at nearly 11%, above 11%. 90 plus days delinquent of total balances. I mean, that's a pretty decent amount.
That's wild.
Going back to the highest level since the financial crisis. And that by itself is kind of within the range, not, it's somewhat concerning. But look at the student loan balance. Yeah. Because we've been in forbearance for so long, we've had all these student loan programs, the delinquency balances of those are essentially zero. And so thinking through like what folks' bank accounts look like, what their cash flows and their budgets look like, now that those payments are starting back up, those student loan payments are starting back up. Well, if they're already at pretty high delinquency balances on credit cards. Well, now what happens when they have to pay student loans? And so that's just a potential crack that I'm seeing that, if you go back into like, 2015, 2017, 2018, it's like, yeah, credit cards were, 8% delinquent and student loans were 9, 10% delinquent, 11% delinquent. You know, adding the two together, gets you to a percentage. But now we have very high credit card delinquencies and student loans really haven't been in the conversation. And so that just could put additional significant stress, on consumers now that those payments have resumed in the most part. So just one little concerning tidbit that I saw that I thought was
This is
interesting.
a great chart there, but to push back a little bit, I haven't seen this data set for going back 20 years, and I love it because if you're looking at that blue credit card line or teal or whatever you want to call it, it's really shocking to me. The news certainly suggests this is a very high figure, but it doesn't look like at any point in the last 20 years that the level has dropped below 7%, which is really
Right.
shocking to me that 7%, are still that far beneath, and maybe 9% is more towards the normal. Maybe the average is closer to over this period of time, maybe 9.5 or 10. So maybe, I mean, we'll
Yeah,
have
and
to
I
wait
don't,
and see how this
yeah,
goes.
and I don't disagree with that. And absent by itself, I would say like this is, it's a little bit higher, but it's not too concerning. It's more just that we're already at this level and no one's been paying their student loans. Right. So
Yeah.
now that they also have to pay the student loans, like what do your budgets look like? If you're already stretched with that student loan and forbearance, well, now we have to pay the student loan. So you know what I mean? Like I feel like that just could be a little forbearance, just a look into what folks are dealing with, in their household budgets.
We'll have to
Just
wait and see.
just a little something. I think there's been some news about the kind of the very large payroll revision that we saw that it was
Can you remind folks at
800.
home? Because I think you and I know what that is, but I don't think
Yeah.
anyone else does.
Yeah, for sure. So the payroll numbers that come out each month and they add up over the year to jobs gained or jobs lost. I believe it was 2.3 million over the course of the year. It was 2.3, 2.8. Should have looked that up. Sorry. Um, and every year there's a revision. So they go and look at state by state unemployment data, which is a much more tangible number. The other data is survey numbers. It doesn't necessarily capture everything. But the state unemployment data is what it is, right? I mean, there's just people filing for actual unemployment, but that's it's a lagging data set. You just can't collect it in time. So once a year they revise it and they say, okay, well, here's the number what we had from payrolls. Here's that preliminary revision number that we get, and we do that in August. And then the final revision we won't get until February of 2025. But usually, and you can see the blue bars and the yellow and the orange bars are usually pretty close. I mean, you get a pretty good sense that the final revision is pretty close to what the preliminary revision was. And we've had the second biggest going back into 20 years since 2008. 800,000 jobs that we had counted, each month, and they say, hey, the payroll is this. We added 145,000 jobs, 200,000 jobs. 800,000 of those were not actually accurately counted according to this revision from the Bureau of Labor Statistics. And so that significantly drops the number of jobs that had been created over the course of the year from I believe it was 2.3 to 1.5. I think that's what the number was. Now, 1.5 million jobs, that's still a lot of jobs. Like we're still very much in an expanding employment market, right? It didn't take it negative. It's not like we lost jobs when we thought we had gained them. But that is a 25+% decrease in kind of what we thought there was at that time. And I think just to point out that it's something we do every year, right? This is not an abnormal thing. It's a large number. But we do revise. This is a revision that happens every year. And there's been some significantly negative ones, right? In 2019, I mean, it was 500 plus thousand. 2010, 400,000. So while this was a big number, not particularly concerning when you look at 1.5 million divided by 12, we're still adding 120, 130,000 jobs a month when you kind of divide that by the total number. So I thought it was something that was kind of on CNBC, flashing headlines. Oh, we're major revision in the jobs. All the jobs were not real. And I don't necessarily think that's the headline here. I think that there's been a lot of commentary about why. I do think that illegal immigration has something to do with it. Because those folks aren't really counted in payroll surveys necessarily, or they are counted in payroll surveys, but not necessarily on the unemployment rolls. So there's some distortions there, with how that's counted. But I thought I thought it was important to point out that yes, it was a major downward revision, but still an expanding labor market.
Yeah, great chart.
And then you mentioned the yield curve, which the 10-year, so the 2-year Treasury and the 10-year Treasury has been inverted, the longest inversion in history, and has just uninverted. So it's at 0.00% today.
Oh, I
It's
didn't
been
realize it
totally
was. I
flat.
didn't realize it was the longest in history. Wow.
Yeah, yeah. The twos tens, yeah, twos tens was, and it got to 0.01, so it officially uninverted. I think one day last week, and now it's a flat 0.00% as of today, and so not always does the uninversion mean good tidings. A lot of times the uninversion precedes the recession. Now we've just been in this kind of holding pattern of looking at this indicator, and we've talked about it several times over the last few years because it's been inverted for a few years. That it has a very high percentage rate of predicting recessions, but doesn't tell you much about the timing of those. And I think we've shown charts several times that it could be 3, 4, 5 years, before that recession comes, ahead of the inversion. But we are officially uninverted as of today. Any
and
inversion comments?
Just to color in a little bit here, if I can, for folks sitting at home and watching. Why is this important? In a normally functioning economy, you'd expect that as you take duration risk, you go to your bank and get a CD for 5 years, you ought to be compensated with a higher interest rate. Where you go to the government in this case and you get a 10-year loan, you ought to be getting a higher interest rate than you get if you only risked 2 years of locking your money up. Okay, so when that inverts, when that changes, it's a major shift in the basic workings and underpinnings of the economy. So it would suggest, and it usually has been correct, that hey, there's something going on here that's out of whack, and that's what Zach's pointing out here on this chart.
Yeah, and a lot of times the 10-year rate, the 10-year yield is very influenced by economic projections. And so the idea when the yield curve is inverted is that the longer term rates are lower because the markets are foreseeing weaker economic periods ahead, and that they're going to, the rates are going to have to be lower to compensate for the weakness. And so you kind of look at that, and that just kind of makes some intuitive sense that the longer term rates are weaker because the economy will be weaker in the future. And that's kind of what that says about the future.
Certainly rates, of course, right? Big institutional money coming in, buying at the longer end of the curve, driving down interest rates. It's a supply demand issue.
And this particular time around, the question is it different, right? Was everything so distorted by COVID, by the shutting down the economy, the massive printing of money, the drastic increase in interest rates, the inflation? Like, did it just break all of the indicators, right? I mean, was that just such a singular event in history, which it truly was? I mean, how our economy was managed through that 18-month to 24-month period, there was no precedence for it, right? And so it created these things that had typically been fairly reliable. And the question is, are they not reliable in that particular context? And we don't know yet. We'll see. But thus far, it has not been. And if the recession does materialize, in the next couple quarters, it will have been one of the longest signal to recession timeframes. So interesting. All that to say, all of those things onto the next chart, going into the Fed funds probabilities of cutting rates. And what we see here is the table of probabilities for the Federal Reserve. On the left-hand side, you have the meeting dates of when they meet. The next one being November 6th and 7th. Something else happens that week. I forget exactly what it is. What else happens that week?
I can't remember, and I certainly don't want to talk about it.
something may happen that week. And then on the horizontal axis up top, is the projected range of what that rate will be. And so as of today, we are at the 5 to 5.25% on the federal funds rate, that very top right box. And you look at the cumulative probabilities on 11/7/2024, that 60% chance we will be at the 4.5 to 4.75, 40% chance of the 4.75 to 5.0, essentially meaning that the market is pricing in a certainty of a rate cut at the November meeting. The question is whether it'll be 0.25 or 0.5. And you can see going through the meetings as you go down, the probabilities shift towards the left, which means that the market is very much pricing in continued cuts in the federal funds rate. And
This is
that
great. This is a great chart.
and it adds up before you get to the end of the year to about 1% of rate cuts. And this is very important for your money market, for your CD rates, for your treasury bond rates, for your credit card rates, for your mortgage rates. It means that all of those things, should these probabilities come to pass, will be coming down.
Well, if maybe I'm reading this wrong, Zach. If I go forward a year, which I think is really indicative, folks are asking, "Hey, what's going to happen this next meeting or two?" But what about a year from now? These are people putting their money down, and it's showing at least 100% chance, 53 and 46% chance that there'll be between 150 and 200 basis point cut. If I'm starting at 5%. That's incredible. That's that's a seismic move here, folks, and we'll have to wait and see if that actually transpires. But that'd be very meaningful for fixed income investors and the market in general.
One important thing to note is that when it comes to the CME FedWatch tool, 100% chance of something doesn't necessarily mean 100% chance of it. So we've seen
you don't say.
We've seen these add up to 100 before, and it be something that's not one of those boxes.
Thank you for that important asterisk.
That's an important asterisk. Doesn't actually mean it's definitely going to happen.
But I think that's kind of mirrored. If you kind of look at the Fed's dot plot, I don't think they're calling for something too much different. I think those are the decisions.
They're a little bit, they're a little bit behind this. So I think they're maybe 0.5 behind what this would indicate,
but still indicate a 1 to 150 basis point.
Yeah, the market's a little bit ahead. The market's a little bit ahead of what the Fed, and that's partly projecting in some potential economic weakness to say that they're going to have to go a little faster than what they're saying. My bet for November is they're going to do 25. It is after the election, technically the day after. Election's on Tuesday. The Fed meeting's on Wednesday.
That's what you're talking about. I couldn't remember.
I just don't think they're going to come in and do 50 the day after the election. I don't know. It just seems like that would be something that would be a little bit too disruptive. That's probably already going to be a fairly disruptive week. I wouldn't be surprised if they then do 50 the following month. To get to 4.25, from 4.75. So, and this, this is important, I think, for folks who are sitting on cash in a money market and it's earning 5% today. 2 or 3 months from now, might not be earning 5% anymore. And same thing with CDs. When you're buying CDs and those are going to come due sometime next year, rates could be significantly different. Housing market, we actually saw one of the lowest readings possibly ever for existing home sales. And I think folks are just like waiting, they're just like holding on. Like we're going to wait 6 months, right? Because we're really anticipating rates to be lower. So I would expect that to probably continue. And it's a microcosm of why deflation is really bad. If deflation is the overall lowering of prices in the economy, whereas inflation is the overall aggregate raising of prices in the economy. And folks might think, hey, deflation sounds great. Prices are going to be cheaper. But when the actual economic reality is when people have an expectation that prices will be cheaper in the future, they don't buy anything. And that creates kind of a death spiral for economies. When people withhold economic activity and the expectation that things will be cheaper in the future. So you kind of just see that in a little microcosm on the housing market where like, oh, rates will be lower in 6 months. I'm not going to do anything. I'm not going to, so it's certainly interesting and something you want to talk with your advisor about if you have a good bit of cash or fixed income maturing or things like that.
Absolutely. Been having a lot of those conversations
Yeah,
lately myself.
absolutely. Um, and so now the next three, I just want to look at rate cuts. Now what? So if we're going to get these rate cuts, what does that mean for equity markets? Kind of what does that mean for asset allocation? And it's very dependent on whether those rate cuts happen in the context of a recession or in the context of an expansion. In the context of a recession, not great. Typically, even though a year out still does have positive returns, but um, below average market returns, some volatility, 3 months out. That typically means, and I kind of tried to look through some of the periods when this happened. Um, by the time they actually cut rates, the market had already kind of fallen in a lot of these situations. So that 5 months, the 3 month out down 5%, that's like after some markets have already declined because they're cutting rates into some sort of economic stress. So I think the thing we have to keep an eye on is, are we in expansion or are we going to be in that recession? And if we're in expansion, rate cuts in an expansion are not bad at all, right? I mean, that's a pretty strong average performance 1 year out, right?
Zach, this is a
16.7%.
great chart. And listen, here's what I'm focused on here and hopefully this is the point you're making too, of course, is when you're out, if there's a rate cut, whether in a recession or an expansion, the idea is that historically speaking, you've got a 5 to 17% upside, right? And should we be jumping up and making huge knee-jerk reactions? No, we should be staying the course. Do you have an idea though, of the occurrences that happened since 1972? What percentage of them were negative, or averages are one thing, but I'm
Yeah,
curious.
that's a good question. I don't have that right
Well,
offhand. Maybe
folks,
we'll pop
focus.
that into the next one.
Tune in next month
Yeah,
for
yeah. We'll try to get that data.
Yeah, this is great.
Um,
I'm gonna highlight this again for my folks in the newsletter. This is really,
yeah, for
really
sure.
great. I mean, people are talking about this. There's going to be volatility in the near term. There always is, but going out 6 and 12 months later, wow, yeah, that's incredible.
Yeah, and then marrying that with the next chart of GDP growth, right? And as of right now, it doesn't look like there's any sign of recession. We're firmly in expansion territory. You know, um, 3% Q2 2024. Could this quarter be the one that starts the recession, right? It's possible, right? But at least as of right this second, it certainly looks like it's more on the expansion side of things. Now, I highlighted one of those concerning indicators at the very beginning. There's several more, record low savings rates, revolving debt pretty high. There's a lot of things you could point to and say, hey, these are the cracks forming. But ultimately, it's GDP growth that's what kind of matters when you're talking about recessions. Um, and as of right now, we're still kind of back into that pre-COVID trend of that plow horse economy, 2.5, not setting the world on fire. We're not going to see the 5% growth that we saw in Q3 2023. I mean, that's just not how our economy operates. But certainly plenty of signs that the expansion could continue. And then finally, what does that mean? And if those two things are true, what does the allocation look like? If you're getting rate cuts and you're getting rate cuts within the context of an expansion, what does that mean? Well, that means that the most economically sensitive and the most leveraged companies tend to do better. And that's going to be small caps. So if you look at, this next chart here, 3, 6, and 12 months out from the first rate cut going back until 1963, I believe this was. Um, and you're kind of segregating it by large, mid, and small cap companies. And you can just see that the best performing tends to be the most economically sensitive and the most leveraged on their balance sheet, which just makes total sense, right? Because they have to roll their debt more often. Their cash flows are further out into the future. And so, that would make intuitive sense.
And I'll highlight
But
there, if I can jump in, this has been a
yeah,
great data set, Zach. This is why we hired you on the show. My God, fantastic data here all across the board. But, interesting, we talked at the very beginning of this episode about where the markets are, and the S&P 500, the broadest index of U.S. stocks, the large cap, is at or near all-time highs. As of Friday, a little bit of volatility here this morning. We'll see where it ends the day or the week or the month or the year. But you know what index, Zach, that I'm thinking of that is not near all-time highs? You want to take a guess?
small
Small
caps.
caps. 20% below all-time high set 2 years ago. So it's been a 2-year bear market for small caps. No one really talks about it because it's such a minor part of the overall capitalization of the U.S. economy, but it really kind of plays into this idea here. If you're looking to rebalance, if you're looking to find a place possible value going forward, it might be a decent shot.
I'll put one little small caveat on it, and that's I do think that the nature of the small cap index, not even that I think, it just has changed pretty significantly over the last 30, 40 years. So some of these comparisons, going back, a few decades, the small cap index is much less profitable. A lot of the best companies, tend to kind of trade up, right? They go right into the mid cap or large cap index. They never go public as small cap. So you think about all the unicorns, as they call them, the $1 billion private companies that end up going IPO. So companies are staying private longer. And this is kind of what we talked about, access to those returns. You got to get them through the private markets. Companies are just staying private much longer. And then when they do go public, they skip the small cap and they go right to mid or large. And so the small cap index is not as attractive as it used to be, because it just, some of the best companies are skipping over it. So
well, I guess
something to note. One little caveat on there.
Did we talk about this
We
one
did.
or two
I think we
podcasts
did.
ago? And it's great.
Yeah.
And I think I think the point I'd push back on, just from data I read, and I'm not pushing back, I'm just having a conversation with a friend, okay? And we're talking about small cap stocks over coffee. But I think it's interesting is that Barron's had an article this week. And I think one thing you mentioned 2 or 4 weeks ago when we had that podcast was, hey, one of the things that's changed is, as you mentioned, stocks are kind of skipping through private investment. They're able to skip the initial capitalization phase in small caps as they grow into the mid and large caps. But on top of that, heck, there's been a lot of companies that have been just unprofitable. They're not making money, right? So Barron just highlighting that. And the point I was making was that, certainly there's been 60-ish or more % of companies that are not profitable. Is that right? God, it sounds so high when you say it out loud. In your head, floating around, it sounds normal.
In the small cap, 60+%. Yeah, it is. Yep.
Wow. Yeah. When you say it out loud, it just really strikes hard. But the point they're making is that, with interest rates going lower, which is the point you're making on this slide here, their net debt service ratios are going to decrease significantly, and many more of those companies are going to pop into profitability. So that's, we'll have to wait and see, right? With risk comes reward. Small caps are certainly more volatile than large caps, but it could be certainly a good place to look going forward, especially, as you mentioned, in a decreased interest rate environment.
For sure. Good
Awesome
stuff.
Well, it's a great podcast. I hope folks stuck around here to pay attention to that really great idea there towards the end. We'll have to wait and see what happens here. But Zach, I really love those slides, the small cap space,
nice.
And then going back there to the rate cuts. I mean, listen, our job as advisors, and we talk about this all the time, is that we're also coaching folks through the good and the bad times, right? It's easy to, have your robo advisor, not pick up the phone because it's a robo advisor, but sometimes it makes sense to stay the course. Or whatever happens in the elections going forward, or whatever happens with the interest rate environment, we can see that, if we're not in a recession, which we're probably not, things look pretty good going forward. And even if we are, things also look pretty good. So, Zach, thanks for that great information, folks. I hope you all found it valuable there when you're sitting at home. If you have any questions, please let us know. And as always, we'll see you in a couple of weeks here on Finance Footnotes.